Thank you so much for coming in on a Saturday, and it's nice to have this August gathering here. So I am filling in on I am just to give you an introduction. I am Niranjan, and Samyukta and I together co-manage along with Mr. Shyam, our founder. We co-manage the multi-asset fund called Sphere. So Samyukta isn't in today. She was supposed to be presenting, but I'm filling in for her. So we can start. So what happens usually? Let me just give you a small brief. What most investors believe. They believe that just picking good stocks, just picking good stocks is enough. And there is one set of investors who think that property, equity, real estate is the only way to invest. And then there is one other set of investors who think that gold is an all-weather investor. Okay, this is the usual set of this is investors can be classified into these three categories because most often not this is how investors are geared towards. So where do most people make mistakes? they they usually go ahead and they end up chasing assets that just went up. Like it's basically there's a lot of FOMO in them, and then at the first sign of volatility, they walk out. For example, they exit if they let's assume the market or that stock or that asset crashes or corrects. They exit at the first opportunity. And then the other bit is they never rebalance. Rebalancing is a very essential bit of asset allocation because we always believe in cycling in and out of assets, but the rebalance never happens. Sometimes what happens is people get overexposed to just one asset class. And then as a result, the fourth point is over owning a single asset class. When you don't rebalance, it leads to you owning too much of a single asset class. So I'm going to be showing you this very interesting bit of data that we have collated since for the last 15 years, which is this is called the asset allocation quilt. So this quilt now shows you what was the best performing asset class since 2010 for that year. So for example, if you were to see in 2010, best performing asset class was gold. Again in 2011, the best perfect performing asset class was gold again. 2012 was mid cap, 2013 was international, 2014 was was the small caps, and so on. And if you were to see in this is the way it has been performing. And if you did see one interesting bit of observation that I think investors should also always take heed is for an interesting for an investor who is if you were to be looking when you look at this quilt. It only shows it leads to only one point. There is no one asset class that has been consistently performing for more than 2 years at any given point in time. So what does that bring to the question? So this is something that what what should be ideally done by investors at different situations. When inflation rises, you go by equity, you avoid debt, and you buy gold. So, but then what actually happens is why this happens is because investors worry about real return and purchasing power and hence go to equity and gold. When there is growth, equity dominates. So people tend not to buy gold or silver, gold or debt. And when there's uncertainty, when equity markets get very shaky, that's when the rush to safe haven assets occur. Safe haven by safe haven, I'm saying debt and gold are considered safe havens. And then when there's a rate hike, whenever there's a rate hike, what happens is in an increasing interest rate scenario, so gold often loses its value in the sense it doesn't appreciate the way it's supposed to appreciate, and debt because by virtue of interest rates going up, there's always a better rate available. So what happens? People just go ahead and people would be ambivalent with equity, and then in a rate cut scenario, what happens is because there's a rate cut that takes place enforced by the central government. What typically happens is that equity is the first recipient of the largest. So because lower rates means lower borrowing costs, lower borrowing costs means better profitability, and debt also does well because interest rates go down. So which basically means the yields move down, which means the bond prices go up. So that's what happens. And but then the last case, which is doesn't happen too often, happens once in a, I would say would be a very typical black swan event, would be a crisis slash shock, which I would say would be emblematic of probably 2008 and probably the first between in the month of March in 2020, where all asset classes consistently lost value during that period of time. And if you this just shows the if you were to be using this, just shows what happens, what kind of returns that you can get from asset classes. What is the probable? What probability do your what are the when you see return ranges? If you may, if just to give you a sense, if you were to look, what's happened is uh, since gold is right now in focus, I'm going to just point you towards gold. If you were to look at what's happened on gold, if you do know this, nearly 15% of the time, gold actually gives zero or negative returns, which most people tend to overlook. And if you were to see equity for a larger period of time, returns anywhere between 10 and 16%. That's roughly about, I would say, about 30% of the time, equity always returns a much higher return. Equity tends to return, and then debt in many a case, I would say, uh, the most probable return ranges for debt would be between the 6 and 10%. 10%, I would say, would be an outlier event, because now that this was probably possible probably 10 years back or 15 years back, but then it is not so going forward, because now we are seeing more and more economies moving towards a lower interest rate regime. But the best bit is if you were to combine equity, gold, and debt together, okay, then the probabilities of making good return, the probabilities of making, say, between a 10 and a 16% return would be about 50% of the time you can, if we are able to manage all these three asset classes in the right way. If you're able to manage the mix in the right way, you can end up with a return scenario that is where anywhere between 10 and 16%. That's roughly about 50% of the time. That's the beauty of the asset allocation quilt. If you were to look at the recent winners, in 2018, gold did 8.4%. It ran really well. 2019, international did well, which is basically your Nasdaq and its allied. And in 2020, that I would say that if you were to be looking what's happened in 2020, in 2020 and 2021 were 2 years where the small caps did extremely well. So say if you had put in, say, money in the beginning of 2020, roughly, you would have pretty much doubled your would have almost doubled your money by the end of 2021. But that being said, most often or not, we don't rebalance the assets, so there is a problem on that note. And the most recent would be silver, where silver doubled in this last calendar year. That's been the outlier event. So which brings me to the classic Munger adage, which is invert and always invert. Asset class returns are never repetitive. That's something that we as a house believe, and this is we I think we you as investors also should be believing in this aspect, because no asset ever consistently keeps giving the same kind of return. That's the reason we are of the view that you should be cycling in and cycling out of assets, because that is how you can maintain a consistent return. Which so what also happens is there are a lot of behavioral traps that investors usually have, which is first is recency bias. I would say now the recency bias would be tending towards most recent recency bias that we saw was on the small cap space, where clients still felt they looked at the last 5 years returns of on the small cap space and have still tend to believe that small caps can do the same, can give the same kind of return. I may just would like to also clarify to you the last 1.5 years, small caps haven't delivered many meaningful returns, and I think the small cap I think the small cap index or the micro cap index by itself is down 15%. So that is one thing that people have to take cognizance of. And the other is the ability for investors to cut their losses. This is something that I think every investor should do it, because what happens is, if you had seen the quilt, if you and since you must have seen the asset quilt, which in which I had very specifically stated that no asset class has been a consistent winner for 3 years in a run. So given that point, I think when an asset class goes out of favor, it does make sense for you as a client to walk out of that asset class. But unfortunately, most clients don't want to do it. And then what happens is, if the cycle prolongs, and say, for example, I would give you the case in point for, I would say, for example, gold between 2014 and 2018 gave no returns. We just held on to it. I mean, while equity did extremely well during that point in time. So, in this kind of situation, if the client didn't sell out in, say, 2013, but just held on to it, the client would have had what I would say, there would be a time value of there was a time value of money. So client would have lost money, and they would have missed out on the other assets. Or in the case of 2008, where clients went full on into the infrastructure funds, and after and the it was only after about, I would say, in 2010 would be the peak of the infra fund mania, and after which the NAVs recovered only in 2022, so 12 years. So I think this bias of loss aversion should be averted. And I think, as investors, if there is a loss, you should be able to take it. See, the tax also allows you to take the loss and move to better asset class where there is a potential. The other bit is herd mindset, which I think again happens because it is a case of everybody is doing it, so why don't I also do it? Which also leads to the which also leads to the problem of diminished returns. This is something that happens when everybody goes and crowds around an asset class, where somebody else has already seen the returns but is still invested there. Everybody else crowds around it because they do not want to miss out. So this also leads to suboptimal returns at many a time. And the other bit is overconfidence or hubris, that we call, happens when let's assume that you had 2 good years on an asset class that's done really well. That tends to lead to a lot of overconfidence, or in our finance parlance, we call it as the hot hand fallacy. And hot hand fallacy is something that we as financial practitioners keep looking at always. So it's a simple fact that the basis of hot hand fallacy comes from basketball, where somebody if he if there's a player who is on a streak where he thinks he's been scoring quite well, he believes that he can shoot from anywhere in the court and still be able to make the shot. That's called a hot hand fallacy. This, I think, this is a problem that a lot of investors have, because they think that the good times will continue to roll, and if there is going to be a bad time, they believe they are immune from the bad time from it. And the other bit is inertia. This is basically, there's too much of is the sheer I wouldn't call it laziness, or I would say it's basically Newton's law. Continue to remain in the same state purely because, one, they're confused and uh, they are not clear in what they want to do next. So that leads to them just sitting on the asset because they're not able to think, they're not able to make a choice. That is what something we call as inertia. And the other bit is confirmation bias, is crowding around yourself with groups that subscribe to your theory from the asset class. There could be some people, say for example, if I were to meet a real estate bull, and if I have bought real estate, and if I were to meet somebody who's extremely bullish on real estate, and he says, yeah, real estate is the best asset class, then I am moving towards confirmation bias. Or likewise, if I were to be a gold bull and I were to just be buying gold, and if I'm sitting around jewelers, so I mean, people would still, I would think that, you know what, this is the best asset class. I would look at all news that uh, points towards validation of my decision. So this brings me to the most important bit as to why rebalancing is important. See, what happens is, these are rebalancing is important simply because this is these are behavioral controls that protects you from yourself. So, for example, you could have you could have pre-commitment rules before you can decide before emotions decide. So basically, you can always decide that, you know what, this asset class can have only this much. You can have fixed allocation ranges, and then you should also have a clear rebalancing calendar where if by this time this process has worked or not worked, you should be, unless evidence points out to the fact that this asset class is still got ability to work, then you should be rebalancing it. And then you should have very fixed exit and entry rules. And the most important thing when it comes to doing is you should have no panic decisions. So basically, don't let your emotions get the better of you, because we most mistakes that we as investors make happens when your decisions are emotionally rude. And then the other bits are avoiding narratives. So strategies, basically investment stories are not strategies. That's the underlying principle. So avoiding hard themes, avoiding WhatsApp tips that you might get, WhatsApp groups where there's a lot of investing ideas that they keep discussing about. And then social media investing, you might see something on Instagram, or well, you might see something on Instagram where some Instagram influencer might be pushing some idea. And the other most important thing would be facts. Facts are not headlines. This is something that you all have to understand. Headlines are made to catch your eyeballs alone. They're not meant for anything else. So take the headlines with a pinch of salt, because the truth is always hidden somewhere in the third page or the fourth page of the same article. And then the other bit is uh, your process should be stronger than what your gut says. So you should have rule-based decisions, and then you should be looking at long. You should be thinking on the long term. And what the most important bit is risk management. That always trumps everything else. And the other bit is consistency. You don't need to be. You just need to be consistent. You don't need to be clever. I mean, your intelligence, your consistency beats cleverness. In fact, there is one quote from Bruce Lee. Bruce Lee used to keep saying this. He is always worried about a man who does just one. He's more afraid of somebody who practices the same move 10,000 times than a person who knows 10,000 moves. So that's where consistency is better than somebody who knows 10,000 moves. That's what I was trying to come at. So this is something that I think as investors, everybody should be looking. How do you self-diagnose your overexposure to any asset class? It could be how much of equity concentration you have, what's your concentration on the equity side, and how much of asset class dependence you have. And you should also be looking at your liquidity, or you're neglecting the liquidity of the asset class, and then the ability to rebalance it. Rebalancing, whether have you embarked on the rebalancing exercise? That is something that you guys need to take a look at. This brings me to what our fund does. Our fund Sphere, this has been the performance for us over since inception. So we follow, we have a very specific process where we work. We we keep rotating asset classes, not because we have to rotate it, because we keep evaluating to see if the asset class has the ability to perform. And two, we also try to take cognizance of the fact what else is there on the asset class. So that is something that we've always been looking at. So these numbers have been quite stellar. We've had a very good, we've had very good traction also as from the investors, because most investors have trusted us, because in the truest sense, Sphere works like the multi-asset portfolio, the multi-asset approach to investing is the truest sense of contrarian investing. And this also tells you what our numbers are in terms of how we've handled drawdowns, what's happened on the whenever there's been a drawdown, what's happened when the index draws down. So, for example, June 22, when the Nifty corrected 16%, on my Sphere PM was corrected by about 11%. And then in March 20 of 2023, again, when the index corrected 10%, Sphere corrected only 6%, because we do have a larger equity exposure, but we've been able to minimize it. And then in November 24 again, if you were to see what now in the last bit of correction was in March 2025, where the Nifty corrected nearly 16%. sphere PMS because sphere PMS corrected only about 10%. That being said, correction, if there is a drawdown, we are not, we are not, if there is a correction, I will just like to point out to you, no asset class is immune to it. So on that note, our fall has been relatively been much lesser than an equity index by itself. So as far as sphere is concerned, you don't have to worry. It's a very simple process. It's a very simple. I think it's a no-brainer when it comes to investing into sphere, because you never have to worry whether it's a good time to invest, because you don't have to worry if the equity markets are high. It doesn't matter, is it a good time to add, where you don't have to worry about where to invest, and you don't have to worry about how much to invest. Sphere in its truest sense is I would say would be the true success, would be a true contrarian portfolio, because you can always buy into assets that are cheap and has the ability to do well. So the advantage sphere brings to you is, one, it's a complete value driven portfolio and is a contrarian portfolio, and does this on the multi asset space. So which basically means it's a jack of all trades. So you have the ability to participate, to add, and don't have to be worried about valuations, because there's always some asset class that we are buying which is always cheap. And in terms of return expectations, I think ideally you should be looking at an average. The we On the risk side, we operate between the conservative to the moderate space. And in terms of return expectations, I think if you were to be looking at an inflation expectation, if you were to be looking, your return should be a little bit, should be about, sphere should be able to do inflation plus 5 to 7%. So assuming that if you were to be thinking at inflation to be about 5%, sphere should be doing anywhere between 10 to 12% very comfortably. And since this is a PMS, so the minimum is at a 50 lakhs, and we don't have an exit load. We our benchmark, because it's also a multi-asset fund, we run against the NSE multi-asset index, and the fee is at a 1.5%. That's calculated on an annual daily average portfolio basis. This is meant for somebody who would like to be, who's keen. Sphere would be is typically an all-weather portfolio that runs in a way that, I think, if you want to be building up a retirement portfolio, that being said, retirement portfolios need not be something that would be a traditional LIC policy. You should be looking at something that will be able to do about the numbers that I was saying, anywhere between inflation plus 5 to 7% would be the kind of return expectation, which means you are meeting inflation by at least by 5 to 7%. And the other advantage that we have on Sphere is that we don't have limits on where we can buy any asset class. So which means if I believe, or if we as a team believe that equity needs to be 100% in, we don't have a problem taking it equity. We don't have a problem moving all money to gold. We don't have a problem moving money to completely into debt, or into, or into any other class that we deem it fit. But that being said, we would not be, purely from a risk metric, we do not want to, we won't take 25% into a single idea, into a single stock. So the key takeaways that I just thought I should let you guys to see why most clients fail in investment in asset allocation is one, because of their behavior, is also because of their concentration towards the asset class and lack of discipline. And from history, we've seen that history rewards diversified and rule-based investing, and not trying to guess what should be the next asset class you should be buying. And if you had and if you were to see what is happening on the I'm sorry. And if you took a look at the quilt, the quilt again says no single asset all wins in any cycle. Asset allocation matters more than the selection, meaning meaningful weightages but at the same time also being sticking to rules so that you take some money off the table when the time is right. And the other bit is rebalancing, which I also brought into this talk into this in the last point is rebalancing and making sure that your emotions are in control. And if you were to be looking, if you were to be following these principles, anybody will be able to do. If as long as you follow these rules, any investor will be able to succeed. If you would like to have any questions, you can ping us on our WhatsApp API. We'll be able to answer your questions on through our WhatsApp channel. Okay. Thank you so much. Thanks for joining in. Thank you so much.